Stop what you're doing, because if you or someone you love receives PIP attendance allowance or pension credit, the rules have just changed, and if you're not aware of the new income limits, you could be missing out on hundreds of pounds every single year, or worse, at risk of losing support you've relied on for years. The DWP has rolled out significant updates in 2026, quietly, without much fanfare, affecting millions of disabled people and pensioners right across the United Kingdom. New thresholds, new qualifying rules, and new traps that could catch you completely off guard if you don't know what to look for. In the next few minutes, I'm going to walk you through exactly what's changed, what the new income limits mean for you personally, and most importantly, how to make sure you're still getting every penny you're entitled to. Whether you're on a fixed pension income, receiving disability support, or helping an elderly parent navigate the system, this video is essential viewing right now. If you find this useful, and I promise you will, please hit the like button right now. It takes just 1 second, but it helps this vital information reach thousands more seniors and families who desperately need it. Let's get started. Now, before we get into the detail, I just want to take a moment to say, if you found this channel for the first time, welcome. Everything we cover here is designed specifically with older adults and disabled people in mind. We don't talk down to you, we don't use confusing language, and we always make sure that what we share is practical, clear, and genuinely useful. So please do subscribe if you haven't already, because this is exactly the kind of content we bring you every single week. Right? Let's get into it, because this is important. The Department for Work and Pensions, the DWP, is the government body responsible for administering state benefits in the United Kingdom. Every year they review thresholds, update guidelines, and occasionally make significant structural changes to how benefits are assessed and paid. In 2026, several of those changes have come into effect simultaneously, and the combination of them is something that every pensioner and disabled person in this country really does need to understand. Here's why this feels particularly significant right now. For a long time, many people receiving disability-related benefits or pension credit were operating under a set of income rules that gave a reasonable amount of flexibility. The thresholds were relatively generous, the means testing wasn't always applied with heavy scrutiny, and for many people, life ticked along. But in 2026, the DWP has tightened several of those frameworks. They've revised income thresholds, updated the definition of what counts as assessable income, and introduced new reporting obligations. And what that means in practice is that some people who were previously comfortably within the limits may now find themselves in a gray area, or even over the line. The changes aren't designed to punish people. I want to be absolutely clear about that. But the reality is that when government systems change, the people who get hurt are usually those who weren't informed in time. And that's exactly what this video is here to prevent. Personal Independence Payment, which most people know as PIP, remains one of the most widely claimed disability benefits in the UK. It's designed to help with the extra costs of living with a long-term health condition or disability, and crucially, it is not means-tested in the traditional sense. Your income and savings don't directly affect whether you qualify for PIP. That hasn't changed in 2026, and it's important to say that clearly because there's a lot of confusion out there. However, and this is the part that catches people out, PIP doesn't exist in isolation. For many people, PIP is just one part of a wider benefits package. They might also be claiming universal credit, pension credit, or housing benefit, and it's in those surrounding benefits where income limits become critically important. When the DWP assesses your overall entitlement to means-tested support, they look at your total income picture. That includes your state pension, any private or workplace pension you receive, savings interest, rental income if you have it, and yes, in some cases, even certain benefits themselves. In 2026, the DWP has updated the capital and income thresholds that apply to several of these means-tested benefits. The changes are relatively modest in percentage terms, but they are real, and they are being actively enforced. If your total household income or savings have changed in the past year, perhaps because you started drawing from a private pension, or because you inherited money from a family member, or because interest rates have pushed your savings income higher, you may now be in a position where you need to report those changes to the DWP and potentially have your entitlement reassessed. Failing to report a change in income or capital is not a gray area. The DWP treats it seriously, and in some cases it can lead to overpayment recovery, which means they ask you to pay back money they've already given you. Nobody wants that letter to arrive, so staying on top of this is genuinely important. Let's talk about pension credit specifically because it affects millions of older people across the UK, and it is, without question, one of the most valuable yet most underclaimed benefits in the entire system. Pension credit is a means-tested benefit for people over state pension age. It tops up your weekly income to a minimum level guaranteed by the government. In 2026, the standard minimum guarantee for a single person has been adjusted in line with the government's commitment to protect older people from poverty. The exact figures are updated annually, and as of this year, the weekly income floor for a single pensioner is higher than it was in 2025, which is good news for many people. But here is where it gets complicated. Pension credit also has an upper income threshold, a point at which you earn too much to qualify. And it's not just about your state pension. If you have other income coming in, a small works pension, savings interest, occupational pension payments, all of that is added together and assessed. The assessment is what's called a capital tariff income calculation, which basically means that even if your savings are just sitting in an account and you're not spending them, the DWP assumes you're generating a certain level of income from them. And that assumed income is counted against your threshold. In 2026, the savings threshold for pension credit remains at £10,000 before the capital tariff calculation kicks in. What that means is if you have more than £10,000 in savings or investments, the DWP will treat you as though you're receiving extra income from that money, even if you're not. For every £500 above the £10,000 mark, they add £1 per week to your assumed income. Now, for someone with £12,000 or £13,000 in savings, that's a small adjustment. But for someone with significantly more, it can meaningfully affect whether they qualify for pension credit at all or how much they receive. This is the kind of calculation that nobody ever explains clearly, and it's why so many people either don't claim what they're entitled to or, on the flip side, claim more than they should without realizing it. Now let's turn to attendance allowance, which is the disability benefit specifically designed for people who reached state pension age before June 2016 and who need help with personal care or supervision due to a physical or mental disability. Unlike PIP, attendance allowance is not income or means tested at all. Your savings, your pension, your income, none of it affects whether you receive attendance allowance or how much you get. In 2026, the rates for attendance allowance have been uprated in line with inflation. The lower rate, for those who need help during the day or during the night, has increased slightly. The higher rate, for those who need help both day and night or who are terminally ill, has also increased. These upratings happen every April, and they're broadly in line with the September Consumer Price Index figure from the previous year. What I really want to emphasize here is that if you're an older person who is struggling with daily tasks, bathing, dressing, preparing meals, moving around safely, and you have never claimed attendance allowance, please look into it after watching this video. The eligibility criteria are broader than most people assume, and the benefit doesn't affect any other income or means-tested payments you receive. Many people leave hundreds of pounds every month unclaimed simply because they didn't realize they qualified or they thought the paperwork would be too difficult. There are free services, Age UK being one of the most well-known, that will help you complete the form at no cost. One of the most practical things this video can do is make sure you understand your reporting obligations, because this is where real financial harm can happen to good, honest people who simply weren't aware of the rules. If you are receiving any means-tested benefit, and that includes pension credit, housing benefit, council tax support, or the means-tested elements of universal credit, you are legally required to inform the DWP if your circumstances change. That includes changes to your income from any source, changes to your savings or capital, changes to who lives with you, changes to your health conditions, and changes to your living arrangements. The DWP now has significantly more sophisticated data sharing systems than it did even 5 years ago. They receive information from HMRC, from banks and financial institutions, from local councils, and from the NHS. So the idea that a change might go unnoticed is becoming less and less realistic. If they identify a discrepancy between what's on your claim and what their data shows, they will investigate, and the onus will be on you to explain it. The right thing to do, and the safe thing to do, is to contact the DWP as soon as your circumstances change. You can do this by calling the relevant benefit line, writing to them, or in some cases through an online account. If you're unsure whether a change is significant enough to report, it's always better to report it than to stay silent. And again, if you need help navigating that process, organizations like Citizens Advice, Age UK, and Disability Rights UK are there to help, usually for free. We're living through a period where the cost of everything, heating, food, transport, prescription support, continues to put pressure on older and disabled people's budgets. The benefit system exists precisely to provide a safety net, and the 2026 updates are, in many ways, a genuine attempt to keep that net in good repair. The uprating of pension credit, attendance allowance, and PIP rates means that payments are keeping pace, at least to some extent, with rising prices. But knowledge is everything. The system will not come looking for you to tell you that your payments should go up, or that you've now become eligible for something you weren't before. You have to know what to look for, you have to understand the thresholds, and you have to take that proactive step of either checking your current claim or contacting the right organization to help you do so. If you take nothing else from this video, take this. If you haven't had your benefits reviewed in the last 12 months, book a benefits check with a local advice service, or use one of the free online calculators like the one offered by Entitled to .co.uk or Turn to Us. It takes less than 30 minutes and could make a genuinely life-changing difference to your monthly income. The 2026 changes are real. The income limits have shifted, and the people who understand them will be in a far better position than those who don't. You've already taken the right step by watching this far. Don't let that go to waste. If this video has helped you understand even one thing you didn't know before, please give it a thumbs up. It genuinely helps us reach more people across the UK who need this information just as much as you did today. Share it with a family member, a neighbor, or a friend who claims benefits or is approaching pension age. And if you have questions, drop them in the comments below. We read every single one and we'll do our best to point you in the right direction. Thank you so much for watching. Take care of yourselves, stay informed, and we'll see you in the next one.